Good morning. It's Monday, the 3rd of February, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming, like always, from Mumbai, India's financial capital. The take. It's somewhat ironic that the day before the government was speaking of removing obstacles to doing business, the 62-year-old founder of a software company called Vakrangee suffered a heart attack during an enforcement directorate raid on his premises. The company in question had a network of one-stop digital convenience stores and has gone through several iterations in its lifetime. It's quite likely that the company or the promoters had their fingers in some activity that attracted the attention of the Enforcement Directorate, which is mandated with investigation of offences of money laundering and violation of foreign exchange laws. Be that as it may, it is telling that one of the promises in the Union Budget presented on Saturday, February 1st, was decriminalizing a raft of economic laws. The Finance Minister had said that the government will introduce the Jan Vishwas Bill 2.0 to decriminalize over 100 more outdated legal provisions to promote the ease of doing business in the country. And this follows the Jan Vishwas Amendment of Provisions Act 2023, which decriminalized over 180 legal provisions. Think tank Observer Research Foundation wrote a report 3 years ago called Jailed for Doing Business, the 26,134 imprisonment clauses in India's business laws. The report had said that there are 1,536 laws that govern doing business in India, of which 678 are implemented at the union or federal level. Within these laws is a web of 69,233 compliances, of which 25,537 are at the union or federal level. In the 12 months up to 31st December 2021, according to a measurement done by the authors of this report, there were an average of 10 regulatory changes every single day. And importantly, of the 1,536 laws that govern doing business in India, more than half carry imprisonment clauses. Of the 69,000 compliances that businesses have to follow, almost 38% or almost 2 out of every 5 carry imprisonment clauses. So more than half the clauses requiring imprisonment carry a sentence of at least 1 year, and so on. Not all misdemeanors, intentional or unintentional, result in the protagonists getting jail time, but the fear is real and palpable, particularly for smaller enterprises. And the threat of jail time leads obviously to corruption, particularly at a local level. Cumulatively, it results in an atmosphere where doing business is like walking on hot sand and constantly hoping you don't burn your feet. Meanwhile, news has emerged that car maker Volkswagen has sued Indian authorities or the Indian Tax Department to quash an impossibly enormous tax demand of $1.4 billion. Volkswagen has said that the ask is contradictory to India's import taxation rules for car parts and will hamper the company's business plans, according to court papers seen by Reuters. Volkswagen's unit, Skoda Auto Volkswagen India, also told the High Court in Mumbai that the tax dispute puts at risk its investments of $1.5 billion in India and is detrimental to the foreign investment climate. Reuters also learned from a government source that with penalties, Volkswagen India may have to pay about $2.8 billion if it loses the dispute. In 23-24, Volkswagen India reported sales of about $2.2 billion and a net profit of about $11 million. No wonder Volkswagen has gone to court and taken the government on. The car maker argues that it is not liable to pay higher taxes as it did not import car parts together as a single kit, but instead shipped them separately, combining them with some local components to make a car. To explain what a kit is, it used a practical analogy of buying a chair online from Amazon, which is then delivered in one shipment with all parts and fixtures needed to assemble the piece of furniture, according to Reuters. Now, there is obviously one or maybe several interpretational issues here, but the consequences are huge. There is also the problem, as it appears, with the law or guideline in this case being used as a jackhammer. A multinational car company told me a few years ago that India represented more than 90% of all tax cases that they were fighting globally, and they were present in dozens of countries. Indian laws are built on going after exceptions, the polar opposite of an honor system where there is belief that most people will follow the law and the few who don't will be managed or tracked down somehow. Almost every amendment to a direct or indirect tax law is to really catch that one potential lawbreaker, increasing the onerousness but on all players and taxpayers, including obviously the honest ones. A simple case is that of tax collected at source imposed to catch Indians who spend liberally on their credit cards overseas. Go above 10 lakh as opposed to 7 lakh earlier, and you will pay a presumptive tax of 20% to be collected by the bank, a highly cumbersome process that took months for the banks to create. Maybe some folks bought several Rolex watches on their credit cards and there was no corresponding customs duty or some other infraction which one can only imagine. But the TCS, like maybe hundreds, if not thousands of such laws, make life difficult for everyone, including those who are enforcing it. And for all the promises we hear, we only see more such acts and laws and guidelines. The budget did address the income tax part of the problem for middle-class India, but not the income part, which has been sluggish for several years. Arguably, there is no magic bullet here. But high inflation, high indirect taxes, and of course limited growth in incomes and wages has made life difficult for most middle-class Indians. A fact tacitly acknowledged by the government in raising the income tax exemption limit to 12 lakh rupees per annum and thus giving more income in the hands of taxpayers. To fix the problems of jobs and employment, we have to create far superior conditions for entrepreneurs to flourish and for businesses to expand. The present conditions do not encourage both beyond a point, particularly the latter, who are likely to bring scale solutions and thus jobs. We have to focus on the unease of doing business in India, not the ease of doing business. And that brings me to the top stories and themes. The United States imposes tariffs on Mexico, Canada, and China, and the trade wars have begun. The stock markets did not get what they wanted on Saturday. A distilled union budget view and fine print. India and China ties are thawing after a freeze. What does this mean in the context of US, China, and India equations? And India launches a fresh effort to kickstart private participation in nuclear power. The history.
This is the Core Report with Govindraj Ethiraj.
Trade wars have begun. The trade wars have kicked off. At least the orders have been signed by President Donald Trump imposing tariffs on China, Mexico, and Canada. Tomatoes, t-shirts, crude oil, and cars are amongst the items that could get more expensive with the new tariffs, according to a Washington Post analysis of international trade data from the Census Bureau. Mexico is the largest source of imports to the United States, followed by China and Canada. Together, they account for about 43% of the $3.1 trillion in goods that are imported. An editorial in the Wall Street Journal called it the dumbest trade war in history. President Trump will fire his first tariff salvo on Saturday against those notorious American adversaries, Mexico and Canada, said the Wall Street Journal. They'll get hit with a 25% border tax, while China, the real adversary, will endure 10%. This reminds us of the old Bernard Lewis joke that it's risky to be America's enemy, but it can be fatal to be its friend, the Wall Street Journal said. Meanwhile, China on Sunday denounced the Trump administration's imposition of that long-threatened 10% tariff on Chinese imports, while leaving the door open for talks with the United States that could avoid a deepening conflict, according to CNBC. Beijing will challenge the tariff at the World Trade Organization and also take unspecified countermeasures in response to that levy, which kicks in on Tuesday. Trump on Saturday announced those tariffs and also said that Beijing needed to staunch the flow of fentanyl, a deadly opioid, into the United States. China's Commerce Ministry said that the Trump move seriously violates international trade rules and also said that fentanyl is America's problem. That was China's foreign ministry saying, and that Chinese side has carried out extensive anti-narcotics cooperation with the United States and achieved remarkable results. Meanwhile, India's move to slash import duties on a slew of items is a signal that industry can't count on protectionist measures from the government, according to India's finance secretary, who spoke on Sunday in an interview quoted in Money Control. He said that we are signaling that India is not a tariff king, adding it was an indication to both the domestic industry as well as investors. Our message is clear, don't get into protectionist mode, the finance secretary said, adding that India's tariffs were much lower than even some of the most developed economies like Japan, and the latest measures were done to ensure policy consistency for investors. The government reduced duties on solar modules and high-end motorcycles, translated Harley-Davidson, something Trump brought up repeatedly in his first term as well, though Harley-Davidson is actually now manufactured in India, so it's not clear how many or which bikes, which are presumably the higher capacity ones, which could benefit as and when they do come in. What will all this mean from an India and China standpoint? That's coming up later in the show. How will the stock markets fare? The stock markets actually did not get what they wanted or likely wanted from the union budget. A somewhat less discussed point is on capital gains. While income tax reliefs are welcome, the conversion of a tax relief into investable surplus is layered, and there is no real guarantee how much will happen, though some will surely trickle in. Those who invest in markets are looking for capital appreciation and obviously less tax on capital gains, of which there was no reference or mention in the union budget. That is one factor that could have changed market sentiment if that was the intent at all. Remember short-term capital gains, that is gains on investments sold within a year, that now attract 20% tax, but that used to be 15% until July last year when the last budget was read out. Long-term capital gains is at 10% plus surcharge, that is holding beyond a year. Meanwhile, the Business Standard is reporting that the Union Budget has clarified that foreign portfolio investors will have to pay long-term capital gains at 12.5%, up from the previous rate of 10%, because this follows the rectification of an anomaly in the tax regime, because of which foreign portfolio investors will no longer benefit from a lower tax rate on listed bonds, debentures, debt mutual funds, and listed preference shares. Some market experts said that this could lead to some liquidation of investments before the higher tax rates take effect. That will be April 1st, 2025, and will apply to the assessment year 2026 and subsequent years, according to that report. So on Saturday, the markets were largely flat as the budget did not specifically enthuse the markets, including the fact that there was clearly more consumption income or consumption demand stimulus that was projected in the hands, or thanks to those tax reliefs coming into the hands of middle class customers. Meanwhile, crude oil, Brent crude over the weekend was about $75.67 or under $76, indicating a general stability or wait and watch to see if US tariffs would actually kick in on Tuesday as threatened. The distilled budget fine print. So what were the takeaways from the union budget in general and specific? What's the immediate and long term, and how many people will benefit from the new income tax exemptions? And there are some interesting numbers coming up. And what made the government reduce taxes for a segment, which is the middle class, which is actually quite small? I caught up with Ashok Bhattacharya, editorial director and columnist at Business Standard, and Jairaj Purandare of JMP Advisors, who also sits on the board of several companies and was earlier chairman of Ernst & Young India.
Couple of points that I would like to make is that this budget seems to signal shifting of gears the way the government is looking at the economy. In a sense that in the post-COVID world, the government was looking at investment as the main stimulus for reviving growth. And I think there has been a change of approach. It may be also seen as the political imperative of bringing about this change at this juncture. But I think it is a shifting of gears that is really becoming very, very clear. Not so much as in capital expenditure has not been completely be done away with. The growth of capital expenditure continues to be in double digits with 10%. But clearly the government is convinced that it is not enough to revive growth, because I think it is little disappointed with India Inc. in not responding to the kind of incentives it thought it gave, particularly a cut in the corporation tax rate. So it wants to give this kind of income tax relief to the middle class. Remember, this middle class is a very small, tiny proportion of India's population. But that is what I think is one. Number two, I would say, is that government is through this budget is trying to prepare this policy apparatus to take on the global uncertainties to some ways, in a sense that the custom duty rationalization seems to be aimed at that. It may not be enough, but I think there are early signals that it recognizes the need for some sort of customs tariff rejig, which it needs to undertake to take on the post-Trumpian world. And number three, and the final point I would make, fiscal consolidation program, in a sense that changing course, moving more towards a kind of a debt anchoring, but probably it requires greater fine-tuning in the sense that it only talks about a 50% debt level that will bring down the fiscal deficit to its desired course, but it does not take into account the fact that today the sum total of the states in this country is actually more than the central budget. So therefore, to inspire confidence of the markets in fiscal prudence, it needs to follow a path that takes into account that what the states are doing at their level. I would limit my preliminary observations to these three broad trends that I see, Ajit.
Thank you, Govind, for inviting me to be here. Of course, broadly agree with what Ashok just mentioned. At the same time, I'd like to add a few important points, I think. One is that this budget actually presents fairly prudent approach to the fiscal. And if you just look at what she said 4 years ago, the fiscal deficit at that time was 9.2%, and they had committed that by next year they will get it down under 4.5%. And they have lived up to that and pretty much made a commitment to go to 4.4% of fisc next year, which is, I think, good. The glide path has been fairly smooth and they've lived up to their promise. I think that's important. But I think one other key thing is that they're also focusing on the debt to GDP. As was mentioned earlier, they are at about 57% at the central government level. And when you add the states, it's about 85%. But clearly, again, they're moving in the right direction. And it's expected that in the next year or two, this will get down to something like 50%, 49%. So that's a very good sign, I think. So the second point I was making is that the government seems to be thinking, instead of just year by year, a more medium term plan exercise, which I think only can inspire confidence. And this I take away from a few examples in the budget announcements. But one of them was in the tax changes that they're proposing. And they're talking of changing the sunset clause not by a year, but by 5 years in several provisions relating to IFSC units, relating to startups, and so on. So I think that's a good sign that they are actually moving towards that sort of thinking. The third important thing is they announced that they want to revamp the tax code. And I'm very glad that they are in the point of doing that. It's going to come out next week. And more importantly, I think, and I'm hoping they carry this through fully, is that this will probably get implemented next year. And before that, will get referred to the Standing Committee on Finance. They will get consultation, feedback from the public at large, from professionals, experts, etc., so that we will have something which is much more robust. These are all signs of, more broader, longer term thinking and radical changes. The other thing which I would like to just point out is that, anything which is being thought through is, I know they sound like policy announcement, but we are in the context of India looking at large policy changes, large spends. So all the numbers are huge. So, while she was cruising along in her budget speech, the finance minister, it's almost like the, last over six, preserved the best for the last and sort of announced the big jump in one sweep, of the income tax exemption going up to 12 lakhs, which was, I think, a very bold, very good move. Because I think, as initially sort of mentioned, it's going to drive spend, it's going to drive consumption, going to drive demand. But importantly, I think if it drives demand, will then drive private sector capex and investment to happen, which is what has been missing in the last few years, despite whatever requests and appeals have been made to the private sector.
Just a quick one on the direct tax code, Jairaj. Wasn't there an expectation that it will be actually delivered now rather than going into a standing committee and that whole process here on for another what looks like a year?
The last budget, which was in July 24, she mentioned that in 6 months, she expects to have this delivered. So there was initially the expectation that it's going to become law starting April 1, 25. But somewhere down the line, we heard news from North Block in our discussions with the government that this is going slow. Then they started accelerating the process because they felt that they really need to live up to what they said. So at one level, I would have liked to see it introduced now, but I'm happy that they are introducing it as a draft paper, as a draft code, will consult widely, will refer it to the standing committee. 60 odd years we've been looking at the old income tax law, which has become so complicated. It's got 1400 plus provisos, by the way. And she's promised that it's going to be far more simpler, more rational. And I do hope they rationalize it and bring it to more current levels, sort of things. But can you imagine reading a law which has proviso after proviso in every odd section?
AKP, so let me pick up on 2-3 points from your comments. So first is, of course, you talked about the middle class being a very small segment and yet obviously getting a fairly significant looking tax break. So the question is, why then?
Because probably the government, in its wisdom, believes that it must shift gears. It's also a refutable fact that it is politically more expedient in today's environment. So there is economic logic. It's a fact that more money in the hands of segment. I did a quick calculation, around 43 million people who will be benefited in general and overall. So the question is, will those 43 million people will keep that money in their banks or put that money in their mutual fund savings, or will they go out in the market and buy goods and services? So that's a gamble, I would say, the government is taken. This is a gamble. More safe and a secure strategy would have been use that 1 lakh crore to invest in avenues and areas and sectors wherein the multiplier effect as far as growth is concerned may not be immediate, may not be immediately 1 year, but maybe in 2 years down the line. I think the government has also recognized the fact that the absorptive capacity of its investment have actually seen deterioration, in a sense that you put the blame on elections, but the elections were over in June. But in spite of that, the first half of the current financial year, well into December, the government could not spend its money. So even in the next year's budget, you have got 1.5 lakh crore given as part of the capex loan to the states. So the question is, the larger government system needs to be more efficient to absorb this kind of additional investment. So probably the government realized the limitations of the government system, and instead of going in for major revamp of the government system to speed up its such investments and yield those results, may have gone in for an easier option of benefiting those 43 million people with higher disposable income, and see that it will result in more demand. And but I think it's a gamble. Once again, I would say that it may pay off, it may not pay off.
Okay. So if you were to put that aside, what's the larger sense you got? I mean, if you look at previous budgets, and I'm also obviously asking this in the context of the US now imposing tariffs on Mexico, Canada, China, and it's obviously a different world. I mean, do you get a sense that this budget is geared for what is happening around us, including maybe equipping businesses to play on a stronger footing, including making life easy for them?
I don't see any attempt in the budget to outline how it wants to deal as far as this global trade is concerned. There is no indication whether the government will like to extend its trading arrangements with different blocks. There is CPTPP going back to RCEP. Maybe RCEP is a strict no-no because of China, but CPTPP is no China. So, there are no indications that prove its exports, which are critical for improving your growth and manufacturing sector. I don't see any such overtures in the budget that we will be more open to joining these trading arrangements. The only thing that I've seen in this budget is the customs duties have been rationalized. And once again, it is responding to US president who is threatening with higher tariffs.
Anything else, AKP, that struck you as something that was, let's say, more long-term-ish, either
I think
directionally or
I
thematically?
think the long-term issue is that is announcements on regulatory framework reviews. I mean, for example, it wants to put in place a mechanism under the Financial Sector Development Council, mechanism by which it can regulate and monitor the manner in which the regulatory functions happen. Similarly, on the non-financial sector, it wants to set up a committee to look into those regulatory architecture. So this is probably taking off from where the economic survey talked about the deregulation stimulus. So the government is following up on that, which is a welcome sign, and it is a long-term in nature. So that is what I would say, which is a very welcome sign, actually.
Right. Jairaj, you mentioned that one of the things the government has done is to give more lease of life to laws. You talked about the 5-year extension. But are you confident that even if we may say 3 years or 3 years to 5 years, that these things stand as they are without, let's say, additional guidelines or subsections being imposed later from experience?
So this is just the sunset clauses that have been extended by 5 years that I mentioned. Politicians have to take a bigger and broader view and not necessarily get completely influenced by what the bureaucrat may want to do, and with some bureaucrats wanting to look at the micros and bring in all these minute permutations and combinations and make the law more complex. In today's world, I didn't see any huge announcements as to how we're going to even attempt to deal with it. There was no mention of it, which was a bit surprising to me. But there's clearly things on the agenda which need urgent attention. I think what the economic survey says is quite right. Get out of the way. Let business do business. just get out of the way. We've also got into a situation where we've just moved from government approvals to regulatory approvals. We're still, if not in the license Raj, but in the regulated approval Raj. That doesn't help. So this light regulation is a must, and I really hope they take it very seriously and act on it within the 1 year that they've promised. So that's very important. On the fiscal side, there's a lot to be done in terms of simplification, especially on the GST side of things. Income tax looks as if it's going in the right direction. But again, the GST Council and the GST notifications and complex laws are not helping. And they just need to help business to carry on with their business. I like the focus on manufacturing, especially in the MSME sector where you're likely to provide more jobs. So clearly the focus is perhaps in the right direction. But I think much more is required in the manufacturing area. And I still believe that we've not really captured the opportunity of China plus one, as they say. So we seem to have missed the bus almost a little bit. And I was hoping that they will get back onto the bus in this budget. They made some noises, they made some changes, especially on the MSME side. But for example, they seem to be adamant on this lower rate of corporate tax, which sunset clause happened last year. I would have liked to see that extended. Invite manufacturing, let people come and set up doing business. You are getting foreign investment, you're getting the dollars, and it's permanent capital, once you get FDI into the country. I would like to see more of that. On the fiscal side, we were expecting a couple of other things like the global minimum tax of 15%. But I think with the US and Trump making adverse noises on the tariff side, I think I didn't see any real strategy articulated so far. And maybe the government is doing its thinking still in terms of how to react should the US raise tariffs. How will that impact us? Will China dump goods into India? How are we going to treat that? How will it impact our exports? And how are we going to counter that? Because if there are tariffs in the US, so some of these things I've heard that work is going on in North Block, etc. But we haven't seen the light of day on that. And I'd like to see that as quickly as possible. And even on the fiscal side, as I mentioned, even the capital gains tax, they said they've simplified it, but it remains pretty complex even as of now. So I hope as part of the new code, they also simplify what they're doing currently on the capital gains tax. So lots more things, but these are just few of the major flags.
AKB and Jairaj, thank you so much for joining me.
Thank you. Thank you, Govind.
The new India-China bonhomie. Last week, India and China agreed to resume direct commercial flights for the first time in 5 years in what is being viewed as a fresh sign of warming relations. Flights between India and China were suspended when COVID hit in early 2020 and then was halted following political tensions and at the border. The announcement follows diplomatic meetings between the two countries in Beijing, and China's foreign ministry also said it agreed to reopen Mount Kailash and Lake Mansarovar in western Tibet to Indian pilgrims this year. But with the United States imposing tariffs on China, how should we view the thawing of India-China relations, and what could that mean in this evolving geopolitical and trade equation? I reached out to Indrani Bagchi, CEO of Ananta Center and columnist on international affairs in the Times of India, and I began by asking her how she was seeing the India-China thaw.
When Trump was elected, in his campaign, he had promised a much more confrontational relationship with China. He has packed the top of his administration, whether on the security front or on the economic front, with what are known as China hawks, whether they're in the defense section, whether they're in trade. And it's not just Commerce Secretary or the USTR, but even his trade czar in the White House, who's Robert Lighthizer. All of these are a part of the whole MAGA sort of worldview that China has been eating their lunch and they will no longer allow that to happen. So the tariffs have had political approval across the board. However, if you see the last 2 weeks, Trump has actually taken a softer line. He had a chat with Xi Jinping, put out a tweet that China and America will solve many problems together. He had said that he would hit China within the first 24 hours. This is literally 2 weeks after he took office. He invited Xi Jinping to help him solve the Ukraine war. It has seemed to everybody watching the US-China relationship that he may be exploring what in Indian diplomatic corridors is called a G2. So sort of a limited deal with China and a carving up of spheres of influence. As we saw today, or rather yesterday, he hit China with a 10%, but he hit Canada and Mexico with 25%. However, if you look at both the trade baskets in Canada and in Mexico, what he's hitting is Chinese rerouting of Chinese exports via both Canada and Mexico. So it is in effect a larger tariff slap on China. Now to come to India, as you correctly said, India did a normalization effort with China just before Trump took office, rather just before the elections. And that was important because it is important for India to be seen to be solving its own problems. It would have been an open wound that could have been used by anybody to leverage a relationship with India. So India did the smarter thing by walking up with China to do a disengagement, which is not, troops have not gone. There are remaining issues on the border which have not been solved. But there is a lowering of the temperatures. As you observed, the Kailash Mansarovar Yatra is back. I think flights will resume, all of which are important in the normal scheme of things, as in a normalized relationship. India remains wary of China. India's principal adversary, principal challenge remains China. There is no change in all of that. But I believe that the effort has been to sort of clear the decks in a way before this new administration comes in.
And therefore, with the US flexing its muscles further, you see India and China. I mean, we're already economically quite strongly connected and more in China's favor in terms of the imports that we do from them. But you see more happening because of this, the new Trumpian view or the new Trumpian moves.
No, I don't. Two things here. One, this whole Make in India also, as it kicks in, not in large ways, but in every small bits, the economic relationship as we know it, which is higher imports from China, very low exports from India, that the dynamics of that relationship will change. And we can see some of that change. And you can see that China too is acknowledging some of that change, because just the one sector, which is electronics manufacturing, where India's sort of moved from 0 to say 4 or 3, China's now taking a view on sending its technicians, sending its engineers to India. If you remember, they've been recalled. They are also, some equipments are no longer exported to India. So it's not that China is not responding either. This relationship will not be at the level that it is. Besides, if the US puts tariffs on Chinese exports of, say, a particular item, India cannot be importing those items and not fear retaliatory secondary tariffs from the US.
So, yeah, for example, I mean, could an iPhone 17, be made in India and 90% of those components come from China and then it be exported to the US, which is exactly what the US doesn't want?
Yes, that's a part which we don't know how that will play out. I mean, Trump could just as well call Tim Cook and say, stop that, this India production, bring it all home.
Private sector comes to nuclear. The prospects of India's private sector getting into nuclear power are bright again. This is presently not allowed by law, but has been spoken of many times over the years. The government has now said it will amend the Atomic Energy Act and the Civil Liability on Nuclear Damage Act. It has also set targets for building small and modular nuclear reactors as announced in the Union Budget on 1st February. In many countries, including the United States, the private sector is actually the key driver of nuclear power production. India has also set a target of 100 gigawatts. 1 gigawatt is 1,000 megawatt of nuclear power by 2047. But there is an interesting history to how this played out and the geopolitics involved in nuclear power. I asked Indrani Bagchi, who just joined us, to also explain the history and what happened behind the scenes in India's efforts to build India's own private nuclear capacity.
Actually, that was literally the most interesting announcement in the budget, to be fair. Certainly for people like me, because, we signed the India-US nuclear deal in 2006. India got a unique waiver for nuclear commerce from the Nuclear Suppliers Group in September of 2008. Then we go ahead and bring into effect an absolutely self-destructive act called the Civil Liability for Nuclear Damage Act in 2010. This act was so poorly drafted. And at the time, it was not just poorly drafted by the Congress party. Frankly, the BJP played a huge role structuring the act in such a way that you would never have industry participation in the nuclear sector. It was why we would do that to ourselves. I mean, we can go on, but that's a different matter. By 2015, it had become very clear that Indian industry that had been part of the nuclear manufacturing sector in India, which it's companies like L&T, Walchand Nagar, etc., BHEL, BEL, all of these, none of them wanted to be a supplier to the NPCIL making nuclear reactors. So that literally took away 5 years out of our. There we asked for Areva, the French company, to build 6 nuclear reactors in Jaitapur in Maharashtra. We asked Westinghouse to build 6 nuclear reactors in Andhra Pradesh and Hitachi to build 6 nuclear reactors in Gujarat. Both Hitachi and Westinghouse walked away. Areva is still there, but only in name. None of them want to build a single reactor because of these 2 clauses in the Nuclear Act. By 2015, the current foreign minister was then the foreign secretary. They put out a set of FAQs which redesignated the supplier. Now, the killer article, if you will, in the Act was an article called 17C that said that suppliers, that the operator who had primary liability for nuclear damage, had to compensate for nuclear damage, had recourse to suppliers to pass liability on to suppliers, which, if you can imagine, nuclear damage would be in the hundreds of billions. So no supplier in the world can actually take on that kind of liability. And it is also against India's own international obligations because it is against India international law or all the conventions on civil nuclear damage. Nobody came in. As you see, we are in 2025. Not a single reactor from overseas has been in India. Cut to 2023, 22, we have a world that is now experimenting with small modular reactors. India is building its own reactors, but it cannot cooperate, collaborate with anybody without amending this particular CLNDA Act. So this amendment comes at a time when the government has figured out that every other course of action is no longer possible.
Finally, we've reached a point where we are turning the page, so to speak.
First to do, we're literally the last to do the right. There is an American-US angle to this as well. The last visit that Jake Sullivan made to India, which is on, I think, the 6th of January, he and the US announced that they would take 3 Indian nuclear entities like BARC, etc., off their entities list. So the restrictions that they had imposed on Indian nuclear entities was gone. If we didn't take up on that offer by amending the liability law, we would have been truly stupid.
Indrani, thank you so much for joining me.
Thank you. Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.